So in this class, we will be discussing the derivations of annuity factor, present value factor, future value factor and all in detail. Right. These formulae were used predominantly in financial management for various requirements. So mastering this will help you to understand the financial related calculations and all. Let's see. First part. This is the timeline 0, 1 to n. If you invest P amount which gives rate of interest maybe 10 or 12 percentage together with how much it should be by the nth period where the interest is calculated cumulatively, interest on interest every year. Is that okay? Now, for the calculation of S, okay, how can we calculate here? You know that S1, the first year S1 should be the P what you have plus interest on that. Interest for the first year being PI. Assume that the P being 1000, rate of interest being 10%. Now what happens here? For the next year, you have to add the interest. 10% on this being 100, which is nothing but what? Multiplying the principal value with the rate of interest, 1000 into 0.1, 1000 into 0.1. So this P and this 100 is nothing but PI. If I add up these two, then you will get 1100 being some value by the end of first year. Right. I can now simplify this P being common in the both the terms. So I can take the P out. So then the new one being P into 1 plus I. P into 1 plus I. Sum for the second year. For the second year, you start with 1100. With that, I am going to add interest. This 1100 is nothing but P plus PI. Am I right? Otherwise, P into 1 plus I. So next year, P into 1 plus I, what you have with that, you have to calculate I. So 1100 into 10% being 110. P into 1 plus I is the value by the end of first year. With that, I have to add the interest. Interest is nothing but P into 1 plus I into I. Where P into 1 plus I common, you can take it out. So P into 1 plus I. Okay. And 1 plus I. If I take P into 1 plus I, the answer being how? If I am taking the P into 1 plus I, okay, P into 1 plus I divided by P into 1 plus I, isn't it? If I take this one out, plus P into 1 plus I into I divided by P into 1 plus I. If I multiply inside, these two cancel. So I have taken the P into 1 plus I outside. Now this becomes 1. Here you get I only. So the answer being P into 1 plus I to the power, P into 1 plus I into 1 plus I. Is that clear? So this one is P into 1 plus I. Within the bracket, P into 1 plus I divided by 1 plus I, P into 1 plus I is nothing but 1. P into 1 plus I into I divided by 1 plus P into 1 plus I becomes I. So 1 plus I. You can now simplify this way. P into 1 plus I to the power 2. Okay. For the sum value by the end of second year, it is P into 1 plus I to the power 2. What happens in case nth value? In case of nth value, the value being P into 1 plus I to the power. As S is for the second year, gives the answer being power 2. If S is for any n year, the power should be n. P into 1 plus I to the power n is the answer. Clear? That's how we can get the formula. So in case of future value factor, this is nothing but future value factor. Right. In order to calculate the present value factor, which is nothing but to calculate P, you can restate this. P is equal to You can take this 1 plus I to the other side, so it becomes denominator value 1 plus I to the power n. Okay, or you can write this way also, s into 1 plus I to the power minus n, 1 plus I to the power minus n, minus n. Is that clear? Hope now you'll be able to understand this one. And if you want to calculate the I, how can you calculate? If I want to calculate I, clear? To calculate the I may use one more calculation step here. So S is equal to P into 1 plus I to the power n. 1 plus I to the power n is equal to S divided by P. 1 plus I is equal to that power n transferred to the other side becomes nth root of S by P. I want only I. To get the I, the 1 will be transferred to the other side. So the formula being nth root of S by P minus 1. This is how we can calculate I. For the rate of interest, I may be applicable in case of population increase will be called as growth rate. So this may be named as growth also in case of non-monetary cases, right? Similarly, in case of economy, we call this being the CAGR. Okay, CAGR. Clear? Now, these are the terms we can use for the same formula. Hope now you'll be able to understand the future value factor calculation, present value factor calculation and all. Clear? If you want to copy along with me. Okay, don't simply listen. Make it faster, we'll go for the next one. So I got the message from Archana and Yohida. What about the others? Come on, keep texting me. Do by heart of this one. Now, listen. The future value factor as well as present value factor, what we calculate here, and the formula also identified. So 3 formulae we have identified. Formula number 1, formula number 2. This is present value factor. This is a formula for calculation of rate of interest. In case of depreciation, that too under WDV method. How can we calculate rate of depreciation, sir? Usually, the rate of depreciation under straight line method being very easy. Amount of depreciation divided by life, divided by original cost into 100. But in case of WDV method, how this will work? This will be similar to the same way, but instead of addition, it's the deductions. That's all. Each and every year you are adding here. But in case of WDV method of depreciation, you are going to subtract. So where the plus is there, you are replacing with minus. That's all. Let's see. 0, 1, 2, n. Original value of the assets here. Year on year, you are depreciating at the given rate, and it becomes scrap value by the nth period. Scrap value by the nth period. Yes, by the end of first year is equal to original value minus depreciation. If the original value of the asset being, I use the term O here for original value, maybe 1000. Applicable rate of depreciation being, say, 10%. Applicable rate of depreciation being 10%. So the depreciation for the next year being, you have to multiply D with the original value. So it means original value into D is the amount of depreciation, which is 100. Similarly, from O, you have to subtract O into D. where O remains constant. In case of future value factor, we have the P here, O, that's all. Okay. So you can take the O out, then it may be 1 minus D. See, here is a P into 1 plus I, here P into 1 minus D. Instead of P, we can use the O also. For the second year, what happens? O into 1 minus D, O into 1 minus D. From there, I have to subtract the second year's interest. For the O into 1 minus D is nothing but WDV by the end of first year. WDV by the end of first year. WDV in the first year end is nothing but O into 1 minus D. Second year depreciation being, with this value you have to multiply with the D. This 900 is nothing but O into 1 minus D. With that D is multiplied. See, O into 1 minus D, O into 1 minus D into D. Here O into 1 minus D is common in both the factor. O into 1 minus D can be taken out, so that this divided by this is nothing but 1. This divided by this one ends with the D. O into 1 minus D, 1 minus D. Otherwise, rewrite this as O into 1 minus D to the power 2. For power 2, okay, the value being O into 1 minus D to the power 2 for Sn. What about the scrap value for nth year? O into 1 minus D to the power n is the value. Is that okay? See here, I will explain. Sometimes you may be asked, original value of the asset being 10,000, rate of depreciation being 10%. What is the WDV by the end of third year? WDV, usually I use the term yes, scrap value by the end of third year. Clear? So under WDV method, from the 10,000 rupees, you have to subtract 10% depreciation for the first year. For the balance, again, you have to subtract 10%. So such a way you have to repeat for 3 years. Rather than that, you can straight away use this formula to get the answer. Here, original value being 10,000 into 1 minus D here being 0.1. 10% can be expressed in decimal, which is 0.1. So 1 minus 0.1 to the power n. Here the power n being 3 times. 10,000 into 1 minus 0.1 is 0.9 to the power 3. Now, so we can calculate power 9 power 3. 0.9 into 2, sorry, 0.9 into equal is equivalent to power 2. Again pressing that, you will get power 3, 0.729 into 10,000. So the WDV in this value being, in this case being 7,290. Okay, so in most of the electricity companies, no, they have the assets for 20 years, 30 years to be used. Very long ago, they could have purchased. Now we need to find out what is its WDV value for the 17th year. If you work out this way, 1 year after 1 year subtracting, it's time consuming. You can simply use the formula. What is the scrap value for any assets where it is depreciated in the WDV method? So you can use this formula. S is equal to O into 1 minus D to the power n. This formula very easily you can remember. Future value factor. Future value factor is nothing but P into 1 plus I to the power n, where plus sign is changed with minus sign. That's all. Plus sign is changed with minus sign. So understand the formula derivations, and you can easily memorize and link one formula with the other formula, so that we'll be master with this. See, traditionally what we do, 10,000 rupees minus depreciation for the first year 10%, 1,000, 9,000, depreciation for the second year 900. This is WDV for the first year, and after this 8,100 being the WDV for the second year, depreciation for the third year being 10% on this 810, and WDV for the third year being 7,290. You will get this answer. Okay, for 3 or 4 years, it's quite a bit easy to prepare like a table, but in case of a 17th year or 18th year, it may be comprehensive and complicated, right? As you are being the professional students in practical life, you will not be expected to get the answer only for a few items. There will be very much calculation involved questions also may be available, applicable in your practical life. So you have to be master with this. Right. Now, as we have found out the scrap value for nth period, the next question is, how can we find out the rate of depreciation? Sir, you can rewrite this one. So, okay, 1 minus d, right? So now what happens? 1 minus d to the power n is equal to s by o, or 1 minus d is equal to nth root of s by o. You can restate this. You can restate this. D is equal to minus d is converted into plus d, and this equation is converted into minus nth root of s by o, and 1 goes to the next side as a minus. To change the sign, it becomes 1. So this is the ultimate answer. Hope now you'll be able to understand these two formulae here. Calculation of scrap value under WDV method for any number of years, you can directly use this formula, as well as how to calculate the rate of depreciation for the WDV method, then you can use this formula. So these two formulas are resembling like what? Future value factors. In case of future value factor, S is equal to future value is equal to present value into 1 plus rate of interest to the power n. Here plus, because each and every year interest is added. In case of depreciation, each and every year depreciation is subtracted. So where there is a plus is now changed with minus sign. And in this case, rate of interest is equal to here minus, no, so that's a plus, so you have to change the sign. So automatically what happens? This becomes plus, this becomes minus. So nth root of future value, s is the future value in this case, divided by present value minus 1. That's how the formula will be slightly changed. Is that okay? Hope you will now correlate these two formula along with the depreciation as well as future value factor as well as present value factor. Clear? Shall I move on to the next one? Next one. Now, finish up copying this along with me. Online students, come and text me. Now, next, see, we have studied all about single investment. Instead of that, if we make a stream of investments up to n period, that too investment made every period end, and these investments together with the rate of interest, it becomes yes. Now how can we calculate, sir? How can we calculate this? Is that okay? Now in this case, see, what happens for this P by the end of nth period? Consider only one P. Okay. If the P being here, it becomes S in the nth period. The relationship could be calculated this way. S is equal to P into 1 plus I to the power n, right? We have borrowed this equation from the future value factor. In this case, the first P is when first year end. So what happens for this first P? In case of this first P, S is equal to P into 1 plus I to the power n minus 1, right? 1 year short. Rather than the P is invested at the 0th period, if you are investing the P by the first year end, you delayed that investment by 1 year, so you are losing interest by 1 year. Second one, S is equal to P into 1 plus I to the power n minus 2. 2 years will be lost. Clear? So when there is a stream of investments called annuity, periodical payment or receipt will be called as annuity. Now I am going to calculate the present value of those annuity or future value of those annuity. See here. For the first P into 1 plus I to the power S is equal to P into 1 plus I to the power N minus 1. Next one being P into 1 plus I to the power N minus 2 goes on. At the last, what do you have? Nth period. What will you have at the nth period? What will you have at the nth period? You have only P. Don't worry. You are investing P amount in the nth period. If you are withdrawing the P amount, you don't have any interest. Last date. Don't get confused with 1 plus I to the power N minus N. Don't confuse. It's only P. Am I right? Hope you will be now able to understand. So if it is being the stream of investments, the present value of the stream, okay, stream of investment is equal to S is equal to P into 1 plus I to the power N minus 1. And next one being P into 1 plus I to the power N minus 2 and goes on. And finally you have the P. To simplify this equation, I can simply multiply this with 1 plus I. If I multiply this 1 plus I, the formula being S into 1 plus I, P into 1 plus I to the power N minus 1 multiplied with 1 plus I, what will be the final answer? Okay, 1 plus I to the power N into 1 plus I, again power will be increased by 1. N minus 1 plus 1 is nothing but only N. Next one becomes P into 1 plus I to the power N minus 1. What happens to the final term? P into 1 plus I. This is equation number 2. Clear? So we have arrived to equations. Now I am going to subtract the equation number 1 from 2. Okay. So I am changing the signs. If I change the signs, what happens here? This one, okay. The first term of the first equation and second term of the second equation are same, cancel. Second term will be cancelled with the third, and last but one will get cancelled with this one. So 3 items cancel, 3 items cancel. In the second equation, the first term, in the first equation, last term remains uncancelled. Is that okay? The first cancel, first and second cancel, second and third cancel, third and fourth cancel, last but one and last cancel. Okay, you can make 3 or 4 numbers, you will get easily understand this one. Now, finally the value being, I multiply this inside S plus Si. Am I right? If I multiply S inside S plus I, and minus S is going to be subtracted from the equation number 1, should be equivalent to first term of the second equation, 1p into 1 plus I to the power n. Last equation of the first equation being minus p. So I have taken this one and I multiplied S inside. Okay, S into 1 S, S plus I, Si. And I subtract this one minus S. And first term of the second equation remains uncancelled, and last term of the first equation remains uncancelled. Plus S minus S got cancelled. You get Si. Here P is common. You can take the P out. If I take the P out, P into 1 plus I to the power n minus 1. Yes. This I can be taken to the other side in the denominator. Hope now you'll be able to understand the formula for recurring deposit factor. This is what about the recurring deposit factor or future value anti-factor. What's the formula for future value anti-factor? S is equal to P into 1 plus I to the power n minus 1 divided by I. That's how we can calculate easily. Clear? Hope now you'll be able to understand this one. Now, to calculate P, what we can do? P is equal to S into I divided by 1 plus I to the power n minus 1. So we have two formulae. Usually the first formula can be used for recurring deposit. Second formula can be used for sinking fund, debt repayment, as well as replacing the assets. For that required fund could be arrived by investing so much money every period together with interest. Is that clear? Hope you will be now able to understand these two formulae. So first formula you understand, second formula also quite bit okay. If it is clear, text me. So we are going to almost complete. Two more extra item. If you learn, then the entire content will be over for the foundation level. Two more content. You spend some additional time so that you'll understand the logics. Clear? Text me. Now, what happens in case this one 0, 1, 2, n. Every period end you have t. Now the question is, what about s here? S here. In this case, you know that by applying this formula, you will get s for the future date. Isn't it? The difference between these two formula, where s is brought to 0th period, it means with that one, you have to multiply with the present value factor. This one will be future value anti-factor. If you use the future value anti-factor, the formula is equal to s is equal to p into 1 plus I to the power n minus 1 divided by I. If you apply this formula, you will get the future value of the stream of payment. But in the green color timeline, you are bringing the s to the 0th period, bringing the today's value. To bring the future values to the today's value, you have to apply what? Present value factor. This is nothing but 1 divided by 1 plus I. Okay. So, you have to multiply with present value factor. The combination of these two formula will be applicable for this one. Then the formula being here s is equal to p into 1 plus I to the power n minus 1 divided by I. This is nothing but what? Future value anti-factor. To bring it to the today's day, we have to divide this by 1 plus I to the power n. From this, I borrow from this. Denominator, it will have 1 plus I to the power n. So in denominator, you have 1 plus I to the power n. This is nothing but present value, summation of present value of all these p's. For this model only, we use the non-scientific calculator to get the p factor for each and every year, and finally we sum up of all these things. P factor for this, p factor for this, p factor this, and take the summation of that. In your non-scientific calculator, you calculate the present value for year after year just by pressing the equal 1 divided by 1 plus I equal, you'll get the p factor. Finally, if you press the grand total button, you will get this factor directly. Hope you will be now able to understand the connection between these two. Sir, can you explain this rather than multiplying with these two formulae and working this way, sir? We can work out that way also. Let's see if you are clear. I'll move on to the next one. So only these 6 formulae, rather than 6 formulae, only 3 formulae. Okay, future value factor, present value factor set 1, and future value anti-factor set 2, present value anti-factor set 3, along with the depreciation variant. That's all. These are the 3 set formulae will have wider application throughout your financial management study at your inter and final. Clear? If it is clear, text me. Now, what happens here? If a stream of payment is there, 0, 1, 2, n, every year end p, what about its s value together with the rate of interest? Is that okay? Which is nothing but the future value anti factor multiplied with the PV factor. Simply you can remember that way. Okay, otherwise you can use the formula calculation this way. Okay, so in this case, s is equal to, first p should be brought to 0th period. Clear? I can write this way: p into 1 plus I to the power minus 1, isn't it? So I use this formula: p into 1 plus I to the power minus 1 for the first year. For the second p into 1 plus I to the power minus 2 goes so on. For the nth period p into 1 plus I to the power minus n, equation 1. As usual, we will arrive the equation number 2 by multiplying with 1 plus I in both the sides. So s into 1 plus I is equal to, what happens? P into 1 plus I to the power minus 1 plus 1. 0 means p. You end with p into 1, p. So minus 1, power minus 1 plus 1 becomes 0. Anything power, anything power 0. Okay, 0 power anything. Okay, anything power 0, the value being only 1. So this becomes 1. 1 into p, you will get the p. Similarly, the next one, p into 1 plus I to the power minus 1 and goes on. Finally, you will get p into 1 plus I to the power minus n plus 1. Okay. Otherwise, I will put this value minus n minus 1 like. Okay. This will be plus 1 like. Okay. Now, what I do? I am going to subtract equation number 2 minus 1. I change the signs here. So ultimate value being, the first equation, first one and second one gets cancelled, second and third cancel, last but one and last cancel. From this very clear, this one, first term of the second equation, last term of the first equation remains uncancelled. So then the value being, I multiply this inside, s plus si minus s is equal to p, okay, minus p into 1 plus I to the power minus n. Plus s minus s cancel. I can take the p out. So s is equal to, if I take the p outside, I can write this way first. Si is equal to, okay, p into 1 plus I to the power p minus, once again, p divided by 1 plus I to the power n. That's how you can rewrite. Okay, to simplify. To the power minus n can be brought to denominator so that minus becomes plus. Now I will take the LCM. If I take the LCM, what happens? 1 plus I to the power n. Okay. P into 1 plus I to the power n. I can take the p out first. If I take the p out, what happens? 1 minus 1 divided by 1 plus I to the power n. To again restate. Of course, you can use this formula also. You can restate the other way so that the calculation may be pretty simple, like p is equal to si is equal to p, take the LCM, 1 plus I to the power n 1 plus I to the power n minus 1. Now S is equal to P into 1 plus I to the power n minus 1 divided by 1 plus I to the power n. This I will come in the denominator side. So this one being future value antifactor, by multiplying with this you will get present value antifactor. Multiplication of two equations. See here, this will be called as future value antifactor. This will be called as present value antifactor. We got this one. This formula also will work. This formula also will work. You have to take the I to the other side. Okay, so in your text the formula may be presented differently. You don't get panicked. Okay, this way of presentation gets a better look, because future value antifactor is connected with the present value antifactor is equal to the present value antifactor. So it seems to be pretty simpler. So I just redrafted in such a way to understand easily. Clear? This is all about annuity factor for present value antifactor. Clear? Clear? So I leave the second part to be calculated yourself. The solution is given in Singar Academy text FM paper. Okay. In the P rather than here, if the P being here, advance, use the same stream, you can calculate. Okay. So in the previous class, I gave the formula, you'll get the formula directly. What happens here? S is equal to P into 1 plus I into this value. So you will get one more 1 plus I extra. Okay, that we have studied already. Under this case, n minus 1, and you have to add 1 finally. In case of payment in advance, if the P being advance, okay, then what about the present value? In the last class, we have studied that one also, right? Clear? Now, last class, the last general illustration. How much I have to invest during my working life so that I'll get 10 lakhs rupees as my pension per month. Surprisingly, we got only 15,000. Now 15,000 seems to be reachable. But though the 15,000 investment seems to be reachable, the 10 lakhs seems to be unimaginable, right? Great, no? You will be crorepati and billionaire also by your retirement. Isn't it? Now let's see that logic. Very interesting logic. 0, 1, 2. If I keep on investing, getting the P value, where S is this one, for the I. Clear? For infinite period. For infinite period. Is that okay? How can we calculate? How can we calculate? Clear? Come on. So for the first P, S is equal to P into 1 plus I to the power minus 1 for first P. Second P into 1 plus I to the power minus 2. Goes on. Finally, we have the P. What about the present value of that P? P into 1 plus I to the power minus infinity. Endless. Clear? Okay. Equation number 1. Now I am getting the equation number 2 by multiplying 1 plus I in both the sides. S into 1 plus I is equal to P into 1 plus I to the power minus 1. Finally, P into 1 plus I to the power infinity minus 1. You're reducing 1, right? Minus, this is minus, then you have to add plus 1. Minus infinity, you have to add plus 1. Now I'm going to subtract the equation number 1 from 2. Change the signs here. The first factor of the first equation and second factor of the second equation gets cancelled. Second and third gets cancelled. Last but 1 and last gets cancelled. Finally, you have, this can be multiplied inside, so s plus si minus s is equal to p minus p into 1 plus I to the power minus infinity. S is cancel, right? So si is equal to p minus p divided by 1 plus I to the power infinity. 1 plus I to the power infinity. Now anything divided by any bigger number to infinity, what happens? This becomes 0 or disappears. If the p being 1, if the rate of interest being 0.2, 20%, 0.2 to the power infinity, it means 1 divided by 1.2 infinity. Just for a logical understanding, those who are not having the mathematic background, you can try this way. Okay, clear? Okay, 1 divided by 1.2. This is 1 time, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. So if I press, keeping on pressing, the value becomes lesser, and it's minus, power minus. Power minus means 0.0006 powers and that. Okay, infinity is the highest possible number. In your non-scientific calculator, just try. It ends with 0 sometimes later. Okay, come on, I think. Okay, that's the logic. 1 divided by 1.2 equal. So you'll get the present value factor for first year, second year, third year. Infinite period. So here power minus 10. It means 0.10 you have to put, valueless, very insignificant value. If you keep pressing that, the ultimate value being 0. Do you get that 0 in your non-scientific calculator? At what level? Probably around pressing 40 or 50 times, it becomes 0. Infinite is the biggest number. So naturally this will disappear. Then the answer being, yes or no? Do you get this or no? In 1/35th operation, it becomes 0. 1/35th itself, infinite is the biggest number. Okay, 128 there becomes 0, right? Then S is equal to P divided by rate of interest. Okay, no issues. 1/35th operation, it becomes 0. S is equal to P by I. Is that okay? What about the P, sir? P is equal to S into I. What about I, sir? I is equal to P divided by S. Very simple one. This is called perpetuity annuity. Annuity perpetuity. Annuity perpetuity. See here, I'll give the illustration here, a small illustration to make you understand the logic. Very interesting logic, right? Very interesting logic. What's that? Now, very interesting logic. Okay, if the principal, if some value is 1000, applicable rate of interest being 10%, then how much will be P? If you invest 1000 rupees in the bank and banker gives you 10% interest, then what will be your present means of interest you are getting? 100. How many days you will get? How many years will you get? You will constantly getting until that 1000 rupees is cancel or becoming zero, you'll get 100 rupees consistently for how many years? Infinite period. In the previous class, if you are able to remember, I think, do we have that? Yeah, I cancelled that sum. Okay. Where is that income? This one, huh? This one. Here, you expect how much? You want to get 10 lakhs year after year, infinite period. After your generation, leaving to your next seven generation. Huh? 7 power 7 generation also you can leave. It means infinite. If you want to get 10 lakhs year on year, how much you need to have at the time of retirement? Which is nothing but S is equal to, okay, S is equal to P by rate of interest. Clear? S is equal to P by I. Here, P being how much? 10 lakhs. I being 12 percentage. Am I right? 12 or 10 percentage? 12 percentage. 0.12. Come on, tell me the value. 12 percentage per annum per month, it should be 0, 1. No. 12% per annum, but 10 lakhs is per month. So, interest rate per month being 1%. 10 lakhs divided by 0.01, you'll get 1000 lakhs. So, 991 lakhs gives you benefit for up to your life end. Matter of 9 lakhs excess, you will be getting the benefit for 7 more infinite period. Infinite period. So simple. It means additionally how much you have to invest. For 991 lakh, another 9 lakhs you have to invest further. Means matter of 9.1% extra. See, calculate around 9% extra. 9 by 991. Sorry, 9 by 91%. Come on, how much is that? So for the 9, instead of 991, you need to get another 9 extra. Then calculate how much it could be extra. 1. You understand? The rider plan. Matter of 9 lakhs need to be extra to have consistently 10 lakhs infinite period. For 991 lakhs, you need to invest 15,410 every month. For getting the same 10 lakhs infinite period, you need to invest another 9 lakhs excess when at the time of retirement. For 991, you need only 15,410. Then for the remaining matter of 9 lakhs, how much you need to know? Only 140. Last class also we calculated this one only. So simple. So because of wider application, so we can have the mental calculations also. Mental calculations, just like a fraction of a second, you'll get all these values. Clear? Are you able to understand? Understand or not? Go and do the lots of practice. And all these things will be converted into not marks, converted into money. Sir, we don't want money, sir. We have our ATM in our own home, sir. 2 ATMs, father and mother. For somebody else, young elder brother, right, or sister. Once later, you need to make money, then you need to understand all this logic. Hope you will be now able to understand this logic clearly. Interesting, right? This is a simple illustration, simple formula. Whenever it is infinity, 100 rupees invested, 10% return means 10 rupees you will be getting infinite period. More than 10 if you get, sometimes later that will be worn out. If you are taking some money from the capital, then it will be exhausted. Okay, to the capital you will be getting 10% means you just take that amount only. You will be getting that infinite period. If you are getting less than that, you will be growing a lot later. All these things are again magics like. See now, we have completed the annuity with infinite period. Continuity, we otherwise call this being continuity. We'll now move on to the variant here. C 0, 1, 2, infinite period. Whatever the P amount I'll get, first year end, I will get some extra amount. Probably every year 10% extra I'm getting. P0 into 1 plus G, growth. Okay, clear? 0, 1, 2, infinity period. If my return in the very first year being 1000, next year I will get 1100, means 10% growth. The next year I will get 1210. So add 10%. Next year again add 10%, 121 extra, 1331 I will get. The next year. So each and every year the return I am getting is increasing by 10%. It is not constant return for infinite period. It's what about the constant growth I am getting infinite period. Okay. If I get 10 rupees today, tomorrow 11 rupees thereafter, 12.1. From there 10% will be increasing. Is that okay? So this value being, we may understand this may be P0, this value P0 into 1 plus I, 1 plus G, growth. Then next one being P0 into 1 plus G to the power 2. In the infinite period, P0 into 1 plus G to the power infinite. Now my question is, what about its current value? If my rate of interest is given as 10% or 13%, whatever it may be. So in this case, I can use a formula similar to the continuity formula. So PS is equal to P0 into 1 plus G, P0 into 1 plus G, or simply P into 1 plus G for the first year. To make the present value, you have to divide this by 1 plus I. Okay. To bring this to the present value, you have to divide this by 1 plus I. Rather than putting this value this way, in order to make it familiar, I put that value in the denominator. Okay. Next year, P into 1 plus G to the power 2 divided by 1 plus I to the power 2 goes on. Finally, P into 1 plus G to the power infinity divided by 1 plus I to the power infinity. This will be equation number 1. I am going to arrive the equation number 2. Okay. In equation number 2, I am going to multiply 1 plus G divided by 1 plus I. Usually you will multiply with 1 plus I only, but here in numerator we have 1 plus G also, so I multiply with 1 plus G divided by 1 plus I. S into 1 plus G divided by 1 plus I is equal to P into 1 plus G to the power 2 divided by 1 plus I to the power 2, P into 1 plus G to the power 3 divided by 1 plus I to the power 3 goes on, P into 1 plus G to the power infinity plus 1 divided by 1 plus I to the power infinity plus 1. Now I am going to subtract the equation number 1 from 2. Here the second equation, second term of the first equation, first term of the second equation gets cancelled. Second and this one will be cancelled, and last but here gets cancelled. So final answer being, I can multiply that s inside. I can multiply the s inside. Is that okay? If I multiply s inside, s plus sg, s plus sg divided by 1 plus I minus s is equal to okay. Here the value being p into 1 plus g divided by 1 plus I change the signs also, right? I change the sign. Probably 1 minus 2 like I can write. Clear? Now, one second. I put the other way, okay? 1 minus 2. So signs will be changed. S minus, right? Here, this becomes plus, this becomes minus. Okay. So p into 1 plus g divided by 1 plus I minus p into 1 plus g to the power infinity plus 1 divided by 1 plus I to the power infinity plus 1. Clear? Now, this becomes disappeared provided if the I being greater than g. If the growth rate is smaller, usually we assume the growth rate is smaller. This is assumption. Assume. Cost is higher. So in the numerator 10 and the growth rate being 1.1, 10% growth rate. In the denominator, growth rate being, interest rate being 20%, 1.2. If in the numerator, you make it one number, it's pretty simple like, okay, 1 into growth rate 1.1 divided by 1.2. So here the growth rate is equal to 10%, applicable interest rate being 20%. So in the numerator 1.1, denominator 1.2. If you are multiplying this again and again, it becomes 0 sometimes later, right? Here you have to assume that the growth rate will be higher only for some sustainable period. Thereafter, growth rate becomes lesser than the interest rate. Because of the higher interest rate, the second thing, if you are applying this for the infinite period, the second term becomes 0. So the ultimate value is this one. Ultimate value being this one. Is that okay? Now, I can try to simplify this one. How? 1 plus I can be taken as a denominator. So s into 1 plus I minus s plus sg, or s plus si minus s plus sg divided by 1 plus I. Am I right? In the left hand side, this one, this entire thing is calculated this way. I have taken the 1 plus I in the denominator. Plus s minus s is cancelled. Ultimately, you have s I minus sg divided by 1 plus I. Is that okay? Or you can take the s outside. If you take the S outside, S is taken out, then you end up with this way divided by 1 plus I is equal to P into 1 plus G divided by 1 plus I. Okay. If I multiply with 1 plus I both the side, okay, next one being, okay, I am multiplying 1 plus I both the side. What happens? You will get S I G is equal to P 1 plus G. If I multiply 1 plus I in both the side, this one will be cancelled, leaving S into 1 minus G, the other side P into 1 plus G. S is equal to, finally S is equal to, next step, S is equal to P into 1 plus G, 1 plus G divided by, okay, P into 1 plus G divided by I minus G, or S is equal to P1 divided by I minus G. This place the P being P0, 1 year later it may be noted as P1. P1 should always be equal to P0 into 1 plus G. So the P0, we started with the P0 only. So P0 into 1 plus G is nothing but P1. This one is a fantastic formula given by Gordon. That's why it is called Gordon's growth model. Gordon's growth model. One of the easiest formulae to decide the share price. Do you want to find out the share price? Apply this formula. How, sir? Can we see that now? We have a separate chapter. Okay, dividend policy as well as cost of capital. For those two chapters, what we have discussed is over. Go and see. In case of dividend policy, Gordon's growth formula, this formula will be there. Okay, where S is equal to, there it may be totally different. P is equal to D0 divided by KE minus G. That's how the formula is. See, notation may be different. Notation may be different. In dividend policy, you can go and see this one. There will have the applications. Clear? So if you are studying the dividend policy, you can borrow this knowledge from here. Now we have one more chapter called stock valuation. I think, do you have that chapter or not? Bond valuation or stock valuation. Do you have that? No, you don't have. At your final level, you have all those things. Bond valuation, C. So one of the interesting concept. Now, S is equal to P1 divided by KE minus G is the Gordon's growth model formula. Rather than it's P1, it may be converted into D1, dividend 1. S is nothing but the price of the share. Okay, the formula is restated this way. This formula is restated this way. Okay, S is nothing but price per share. D, the P what you get is nothing but dividend per share you are getting later on. And I is nothing but expected return by you. What's the expected return for your investment? And G is the growth rate the company is giving you. This formula is one of the fantastic formula for right valuation of shares price. This will definitely stands correct in my life. Okay, I have used these kinds of formula only. So the other day I addressed in a college. To them also they asked me, how can you predict the shares price? I tell them, whatever the fundamental financial managements you study, that will definitely work. Be patient. Somehow the rate will be adjusted as per the rate we calculate here. Is that clear? Now see, for your example, I'll take some shares in practical experience. Okay. No, derivation is not required to memorize, but it's better to put some practice. Your brain will catch up with all the calculations easily. That's all. Okay. Don't panic with the derivations and all. Okay. Let me see. Let's see one company, IOC, Indian Oil Corporation. Okay. All the numbers are already given. All the numbers are available in the site itself. You can search and pick. IOC. Their data is given here. Numbers. We have been given EPS. EPS being 10 rupees. Earnings per share. What is the dividend per share? 2 percentage. It's dividend yield. Dividend yield means 2 percentage. For 150, 2% should be how much? 3 rupees. 3 rupees they have paid the dividend. Is that okay? 3 rupees they have paid the dividend. What about the growth? Actually, this company shows weaker trend. We may go other companies. Okay, having the growth like. Probably I'll go for RECL. Okay. You keep watching every quarter. Here the dividend yield is 0.37. Who's he? Okay. RECL. Okay. I'm not getting PFC. Okay. We'll see at least this one. Okay. Power Finance. Let's see. Net is very slow. The growth rate is 16 percentage. The growth is 16 percentage. Dividend is almost closer to 4 percentage. Current price is 425. Okay. I'll record all this value. Current price is 425. Dividend is 3.75 percentage. Then what about the dividend you are getting? 17 rupees. And growth being, what is the growth rate they have? 16 percentage. We'll make the 16 percentage for the calculation as 8 percentage. We undervalue. We don't need to overvalue this. We'll do slight adjustments. Exorbitant growth is there. No, we'll adjust for our some other concern. It may be 8 percentage. Okay, 8% or 10 percentage. We'll have small number. What is your expected return? If you are investing in the bank, you should get only 6% or 7 percentage. Always you know that this stock market is riskier. So for the risk, you need to expect some more, right? So we'll go for 14%, 12 percentage. If I start with my expected cost being 12 percentage, okay, how much I will be able to pay this shares price? Apply this formula. Dividend 1, the dividend what we earned in the last year also we expect in the coming year. So in numerator 17, K being 12 percentage, and the growth it shows being 10% will be adjusted for the smaller number. What's the final value you are getting? 850. Now what is the value at which it is traded in the market? In due course, today's worth, as per our Gordon's growth model, it seems to be worth 850 rupees. Be careful, today's scenario. Tomorrow the company may face differently. So each and every quarter the result, you just feed that in this formula. You will guess what could be this price, and based on the some other factors also you adjust. Seems to be pretty cheaper, isn't it? So if we talk about this one, no one likes it. Sir, you are not advising properly, sir. But in my study, since my day one entering into the stock market, I used all these fundamental techniques for my stock market analysis. Usually that time seems to be illogical and foolish, right? But 3 or 4 years later, definitely fetch. Okay, good return. So whatever the study you do know here has a fundamental. If you ask me whether it is for our mark making, no, it's very least important, these concepts. But money making, of course, these things are very, very important. Clear? Hope now you'll be able to understand. Anyhow, the concept what I have taught you here is called Gordon's growth model. Actually, it's applicable for what? Growing annuity. Growing annuity. You are getting consistently dividend n number of infinite period, then this business will be valued so much. Two more aspects to be covered. Those things are covered along with the dividend policy later. There also I may either give the formula derivations or skip the formula derivation or go for just mugging up the formula. That's also okay. Walter model as well as two-stage growth model or three-stage growth model or infinite rather than infinite period. 5 years growth model will also be there. How can we calculate? Those things we will be studying along with the dividend model. For that also the derivations given in the text itself. Those things not required, but if you want to learn further, you can go on learn that. Is that okay? So that's all for today. இதெல்லாம் எக்ஸாமுக்கு தேவையான நினச்சி பார்க்காதீங்க, படிங்க, டீட்டெயிலாக படிங்க. ஓகே, மணிக்கு யூஸ் ஆகும்.